Hello, my name is MC Mendy Jasmine. I will present about the company background and industry background. Now, I would like to introduce Tiongnan Logistics Holding Berhad. Tiongnan is an integrated logistics service provider based in Malaysia and the Asia Pacific region. The company was established in 1975 by Ong Yong Nyok, starting as a small cargo transportation business. Over the years, Tiongnan expanded its operation and became a full-service logistics company. Today, it provides transportation, warehousing, freight forwarding, cold chain logistics, and supply chain solutions to various industries, including food and beverage, automotive, electric and electronics, and information technology. The company operates in several countries, including Malaysia, Singapore, Thailand, Vietnam, Laos, and China. Its headquarters are located in Johor Bahru, Johor. Guided by its motto, "You call, we deliver," Tiongnan continues to focus on efficiency, innovation, and customer satisfaction, making it one of the leading logistics companies in the region. For the industry background, Malaysia logistics and transportation industry plays an important role in supporting trade, manufacturing, retail, and supply chain activities. The growth of globalization and e-commerce has increased the demand for faster delivery, warehousing, and integrated logistics services. Tiongnan Logistics Holdings Berhad is one of the leading logistics companies in Malaysia, providing transportation, warehousing, cold chain logistics, and supply chain management services. As demand continues to grow, the company has opportunities to expand its business and strengthen its market position. However, the industry is becoming more competitive. To improve efficiency and customer satisfaction, companies are adopting technologies such as digital tracking system and warehouse automation. Despite challenges like economic uncertainty, labor shortage, and rising fuel prices, the logistics industry still has a strong long-term growth potential.
Good morning everyone. Today I will be presenting the competitive environment of Tiongnan Logistics Holding Berhad. Tiongnan operates in the transportation and logistics industry, which is highly competitive and rapidly evolving in Malaysia and across Southeast Asia. The logistics sector plays an important role in supporting trade, supply chain, manufacturing activities, and the growth of e-commercial markets. The Malaysian logistics industry is highly fragmented, with many companies offering trucking, warehousing, freight forwarding, and delivery service. Tiongnan competes not only with local logistics providers but also with multinational companies that propose stronger financial resource, advanced technology, and wider global networks. One of the Tiongnan key competitive strengths is the integrated logistics service. The company provides a wide range of service, including tracking, container haulage, warehousing, distribution, freight forwarding, and last-mile delivery. By offering complete logistics solutions, Tiongnan is able to meet diverse customers' needs and strengthen its market position. Another important advantage is its strong regional network. Tiongnan has operations in Malaysia, Singapore, Thailand, Vietnam, Laos, and China. With more than 1,050 trucks and extensive warehouse facilities, the company is well positioned to support cross-border trade and regional supply chain activities through Asia. Technology has also become a major factor in competitive within the logistics industries. Companies are increasingly adopting warehouse automation, real-time tracking systems, and data analysis to improve efficiency and customer service. Tiongnan continues to invest in logistic infrastructures and integrate supply chain management to remain competitive in the digital era. However, the company also faces several external challenges. These include fluctuating fuel prices, labor shortage, regulator compliance requirements, and global economic uncertainties. In Additional geopolitical tensions and trade restrictions may affect logistic demand and increase operational risks. In conclusion, Tiongnan has established a strong competitive position through its integrated service, regional presence, and industry experience. To maintain its competitive advantage, the company must continue investing in technology, expanding its capabilities, improving efficiency, and adapting to changing market conditions. That's all from me. Thank you.
Hi, my name is Borson. Today I'm going to talk about current issue of Tiongnan Logistics Holding Berhad. So first of all, the current issue that they're facing is the impact on profit margins despite high sales growth. Okay, first the logistic and warehousing activities have generated more income, but its net profit has been impacted by greater operational expenditures, financing costs, and decreased fair value gains from investment properties. Okay, second is logistic industry experiencing labor shortages and rising staff expenses. So by this, Tiongnan Logistics implemented automation and technological solution to boost productivity, continue to provide a barrier in maintaining service quality and operational efficiency. So third is the environmental, social, and government's ESG compliance. So for Tiongnan, they engage in green logistic projects and sustainable warehouse management methods to fulfill rising demands. Okay, and lastly, fuel price changes and global supply chain uncertainty are continuing issues. So this is where the fuel price changes and global supply chain uncertainty are continuing issues. Transportation expenses are particularly susceptible to fluctuation in fuel prices, and geopolitical tension, trade policy changes, and interruption in global supply chains can all have impact on freight demand and logistic operation. The external influence might rise operational expenses and generate uncertainty in business planning and revenue forecast. Thank you.
Hello, I'm Dayang Haiza, and for now I will explain on the consolidated group financial statement of Tiongnan Logistics Berhad for the financial year ended on 31 March of 2023, 2024, and 2025. It will mostly cover on the consolidated income statement, statement of financial position, statement of changes in equity, and statement of cash flows. First is the consolidated income statement. Here, the revenue is increased from Rm 725.7 million in 2023 to Rm 758.6 million in 2024 and further to Rm 856.8 million in 2025. This shows that the company continued to grow its logistics and transportation business. But however, the costs also increased, especially cost of sales and finance costs. As the result, profit attributable to shareholders rises up from Rm 27.9 million in 2023 to Rm 57.3 million in 2024 before declining to Rm 42.6 million in 2025. This indicates that the 2024 is the company's strongest year in terms of profitability. Next is the statement of financial position or balance sheet. The total asset increased significantly from Rm 2.60 billion in 2023 to Rm 3.36 billion in 2025. The growth was mainly driven by the increases in property, plant and equipment, as well as investment properties. At the same time, total liabilities increased from Rm 1.70 billion to Rm 2.28 billion, mainly due to higher loans and borrowings. Despite this, total equity also improved from RM 900 million to RM 1.08 billion, which shows the overall growth in the company's financial position. Moving on to the statement of changes in equity, the total equity increased consistently over the 3 years. The share capital remains stable at about RM 200 million, while reserves increased from RM 689.6 million in 2023 to RM 867.5 million in 2025, this reflects the company's ability to retain earnings and strengthen the shareholder value over time. Finally, the statement of cash flows shows that the company continued investing heavily in long-term assets and expansion projects. The borrowings increased to support this investment, while cash and cash equivalent remain relatively low at around RM 8.7 million in 2025, this suggests that much of the company's cash was used for investment in financing activities. Conclusion, the Tiong Nam Logistics Berhad showed a strong growth in revenue, assets, and equity from 2023 to 2025. Although profitability declined in 2025 due to rising costs and borrowings, the company remained profitable and continued to expand its operation.
Assalamualaikum and good day everyone. I will present section 4.1, which is the vertical and horizontal common sense analysis for Tiong Nam Logistics Holding Berhad for the financial year 2023 to 2025. For the vertical analysis, revenue and the asset were used as the base value of 100%. For the income statement, cost of sale remained above 80% of revenue throughout the period. Gross profit margin improved to 18.31% in 2025, while net profit margin was highest in 2024 at 7.61%. For the financial position, non-current assets represented more than 84% of total assets, showing the company's strong investment in long-term asset liabilities accounted for about 2/3 of total assets, while equity remained stable at around 1/3. Overall, the company maintained a stable financial structure while continuing to expand its long-term assets. For the horizontal analysis, the focus is 1 year to 1 changes. Revenue increased consistently by 4.54% in 2024 and 12.93% in 2025, indicating business growth. The company achieved its strongest profitability in 2024, with profit for the year increasing by more than 100%. However, profitability declined in 2025 despite higher revenue, mainly due to higher operating and financing costs. Meanwhile, total asset, equity, and liabilities continue to grow, reflecting ongoing business expansion. In conclusion, Tiong Nam experienced strong growth from 2023 to 2025, although profitability weakened in 2025 due to rising costs.
Hello, good day everyone. For the first part of liquidity analysis, I will discuss the current ratio, quick ratio, and cash ratio of Tiong Nam Logistics Holding Berhad. Firstly, the current ratio decreased consistently from 0.72 times in 2023 to 0.59 times in 2024 and further to 0.52 times in 2025. This means that the company had only RM 0.52 of current asset available to cover every RM 1 ringgit of current liabilities in 2025. The ratio remained below 1.0 throughout the 3-year periods, indicating that current liabilities exceeded current assets. Secondly, the quick ratio also show a declining trend, falling from 0.48 times in 2023 to 0.36 times in 2025. Since inventories are excluded from this calculation, the ratio provides a stricter measure of liquidity. The decrease suggests that the company's liquid assets such as cash and receivables were not sufficient to fully settle its short-term obligation. Lastly, the cash ratio remained very low during the period. It was 0.046 times in 2023, increased slightly to 0.061 times in 2024, and then decreased to 0.047 times in 2025. This indicates that the company maintained only a small amount of cash compared to its current liabilities, and therefore relied heavily on operating cash inflows to meet short-term commitment. So overall, these three ratios indicate that Tiong-Nam's short-term liquidity position weakened from 2023 to 2025. Okay, next I will discuss working capital and sales to working capital ratio. Working capital measures the difference between current asset and the current liability. Throughout the 3 years period, Tiong-Nam recorded negatively working capital. The deficit increased from negative Rm 160.1 million in 2023 to negative Rm 336 million in 2025. This means that the company's current liabilities consistently exceeded its current asset, creating greater liquidity pressure over time. The negative working capital position was mainly caused by increasing short-term borrowings, freight payables, and financing requirements associated with warehouse expansion and logistic operation. Despite this situation, the company continue to generate stable revenue and expand its business activity. In addition, the sales to working capital ratio remained negative throughout the period due to negative working capital position. The ratio became more negative in 2025, indicating that the company relied heavily on short-term liabilities and external financing to support sales growth and operational activities. In conclusion, although Tiong-Nam continued to achieve revenue growth and business expansions, its liquidity position weak over the 3 years. Therefore, the company should focus on improving liquidity management and working capital control to strengthen its short-term financial stability in the future.
Assalamualaikum and salam sejahtera. Today I'll be explaining about capital structure and solvency. First of all, debt to equity ratio. In 2023, the company recorded a debt to equity ratio of 1.89, which means it has 1.89 ringgit in liabilities for every 1 ringgit of shareholders' equity. This indicates that the company relied quite heavily on debt financing to support its operation. And in 2024, the ratio increased to 2.12 as total liabilities grow faster than shareholders' equity. This shows that the company became more leveraged and increasingly dependent on borrowed funds during the year. In 2025, the ratio slightly decreased to 2.11. Although liabilities continue to increase, the growth in shareholder equity helps stabilize the company capital structure. Overall, the debt to equity ratio remained above 2.0 in both 2024 and 2025, indicating a relatively high reliance on debt financing. While this may help support business growth and expansion, it also increases financial risk and the company's responsibility to meet its debt obligations. Next, debt ratio. The debt ratio means the percentage of a company's total assets that are financed by liabilities. It helps us understand how much the company depends on debt to support its assets. In 2023, the company recorded a debt of 0.65. This means that 65% of its total assets were financed by liabilities, indicating a relatively high reliance on debt financing. In 2024, the ratio increased to 0.68, showing that the liabilities grew faster than total assets. This suggests that the company became more independent on borrowed funds to finance its growth. And in 2025, the debt ratio remained stable at 0.68, indicating that the company maintained a similar level of debt financing while balancing the growth of its assets and liability. Overall, the company consistently relied on debt to finance a large portion of its assets between 2023 and 2025. Last but not least, debt to tangible net worth ratio. The debt to tangible net worth ratio measures that the relationship between a company's liabilities and its tangible net worth, which is calculated by subtracting intangible assets from shareholders' equity. This ratio helps evaluate a company's financial strength based on tangible assets. 2023, the company recorded a ratio of negative 1.321. This occurred because the value of intangible assets exceeded shareholders' equity, resulting in a negative tangible net worth. In 2024, the ratio improved slightly to negative 1.2 to 1. Although it remained negative, the improvement suggests that shareholders' equity increases faster as rate than intangible assets. 2025, the ratio remained stable at 1.2 to 1, indicating no significant changes in the company's financial structure.
There are three ratios were analyzed: net profit margin, return on asset (ROA), and return on equity (ROE). Net profit margin increased from 3.87% in 2023 to 7.61% in 2024, showing improved profitability. However, it increased to 5.10% in 2025 due to higher operating and financing costs. ROA improved from 1.08 in 2023 to 1.93% in 2024, indicating more efficient use of assets, before declining to 1.30% in 2025. Similarly, ROE increased from 3.12% in 2023 to 6.02% in 2024, reflecting better returns to shareholders, but fell to 4.05% in 2025. In conclusion, 2024 was the company's strongest year in terms of profitability and return. Although revenue continued to grow in 2025, higher costs reduced overall profitability. Tiong Nam remained profitable and continued generating positive returns for its shareholders. Thank you.
Today, I will present the company market performance from 2023 to 2025. All familiar data and trends are summarized here on this single slide. I will explain the 6 key indicators. The first one is earnings per share. From 2023 to 2024, EPS increased. Net income rise significantly, directing lifting earnings per share. From 2024 to 2025, it fell due to lower operating profit, but still remained higher than 2023. The second one is price to earning ratio. From 2023 to 2024, it increased. Share price rise, earning improved, and investors are willing to pay more for our earning. In 2025, it decreased. Share price only rose slightly to 2.05 ringgit, but earning grew much faster. Price did not match profit growth, so share become undervalued. The third one is dividend yield. 2023 to 2024, there is no change at all. No dividend has been declared. All profit kept for operation expansion and debt repayment. From 2024 to 2025, sharply increased. First, dividend of 1.84 ringgit per share paid at share price 2.05 ringgit. The payment was very high relative to price. Next, degree of financial leverage 2023 to 2024 slightly decreased. Earning before tax grew faster than finance costs. Debt well managed and stable. In 2025, sharp increase. Finance costs rise sharply while profit fell. More borrowing and higher interest made earning more sensitive and rising financial risk. Next, dividend payout ratio. 2023 to 2024, there is no change at all. All profit reinvest for growth and financial strength. In 2025, increase. Dividend distributed, so the proportion of earning was paid out. And the last one is percentage of earning retained. 2023 to 2024 decrease. Dividend increase, so less profit kept inside. True, still very high. In 2025, further decrease. Dividend remained high. Retention fell as management shift strategy to share more profit. To conclude, the company performed well and create good value for shareholder. Going forward, management only needs to control debt carefully to balance dividends, growth, and financial stability. That's all from me. Thank you.
Hello everyone. So I would be presenting the cash flow analysis for Tiong Nam Logistics Holdings Berhad from the year 2023 to 2025. So first of all, the operating cash flow per share shows that there is a steady increase from RM 0.288 to 0.235 in 2024 and finally 0.377 in 2025. There is growth despite slight increase in shares in 2025. This indicates improving operational efficiency and cash generating capacity for Tiong Nam Logistics. The cash flow to total debt ratio remained low but slightly improved over the period. It was 0.10 in 2023 and 2024 and increased slightly to 0.11 in 2025. This means that operating cash flow covered only 10 to 11% of total debt. While modest, the slight improvement reflects growing capacity to manage debt obligations over time. Next, the ratio of operating cash flow to current maturities of debt shows that the company's ability to cover short-term obligations. The ratio increased from 0.37 in 2023 to 0.39 in 2024 and 0.44 in 2025. Although this is still below 1, this indicates operating cash flow alone cannot fully cover current debt. The upward trend shows that the company's short-term liquidity is gradually improving. Finally, regarding cash flow to cash dividends, the company did not pay any cash dividends during 2023, 24 or 25. Therefore, the ratio is not applicable. This conservative approach allowed the company to preserve cash for operational growth and debt management while maintaining strong liquidity.
Hello everyone. Today I will present the summary of financial analysis of Tiong Nam Logistics Holding Berhad from 2023 to 2025 year. Firstly, the company demonstrates several strengths. Revenue increased consistently from 725.7 million in 2023 to 856.8 million in 2025 year, indicating the strong demand for its logistics and warehousing service. The company also maintained positive profit through the 3 years, showing that its core operation remained profitable. In addition, the growth in total assets reflects ongoing business expansion and investing in operational capacity. However, there are also some weaknesses. The company liquidity position has worsened over the year. The current ratio declined from 0.72 to 0.852, while the credit ratio decreased from 0.48 to 0.36. Furthermore, negative working capital worsened from 160.1 million in 2023 year to 336.0 million in 2025 year. This figure indicates that the company relies heavily on short-term liquidity and may face challenges in meeting short-term financial obligations. In terms of performance and industry relevance, Tiong Nam have benefited from growth in the logistics sector, particularly due to the increasing e-commerce activity and regional trade. While revenue continued to grow, profitability weakness in 2025 as profit before tax declined from 67.9 million in 2024 year to 35.2 million in 2025 year. This was mainly due to the rising operating expenses and finance costs. Regarding the bankrupt risk, the company does not appear to face immediate financial distress because it continues to generate revenue, maintain positive profit, and expand its asset base. However, the weak liquidity, increasing borrowing, and higher finance costs indicate a moderate level of long-term financial risk. In conclusion, Tiong Nam Logistics Holding Berhad remain operationally strong and continue to grow. However, improving the liquidity management and controlling the debt level will be important to ensure the long-term financial stability and sustainable growth. That is all. Thank you.
Good day everyone, my name is Ashwini Arulda Singh, DG24110292, and I'm going to present about conclusion and recommendation for this assignment. So in conclusion, our analysis of Tiong-Nam Logistics Holding Berhad from 2023 to 2024 shows that the company has experienced steady growth and remains an important player in Malaysian logistics industry. Revenue increased from 725.7 million in 2023 to 856.8 million in 2025, and the company remained profitable throughout the period. This indicates strong demand for its logistics and warehousing services. However, several financial challenges were identified. Liquidity ratios remain below ideal level, and the company record negative working capital, indicates reliance on short-term liabilities. In addition, higher borrowing and finance cost has increased financial risk and affecting profitability. To address these issues, we recommend that Tiong-Nam have to improve its liquidity management and reduce dependence on debt financing, continue investing in technology and automation, and for support the future growth. Overall, Tiong-Nam remains financially stable and competitive. A better liquidity and debt management will be essential for long-term sustainability. Thank you.